Hello and welcome to Hardman Talks. I'm Larissa Adams and I'm with Hardman Co's Renewables analyst Nigel Hawkins. Nigel, thanks for joining me today. How are you doing?
My pleasure. Yes, it's been an interesting year for the various stocks we've been following, which we'll look at more carefully shortly.
Yeah, well, we're excited to hear from you. Nigel has just released his latest note with a focus on the UK's 9 quoted infrastructure investment companies and the 20 renewable energy infrastructure funds and how they've performed in 2024. So the note is titled A Year of Trials and Tribulations. Only Cordian and Pantheon buck the trend. So I guess from that alone, I think we know that 2024 was another tough year for the sector. But let's get into it. So how did the combined sector of IICs and reefs perform in 2024?
The brief answer is pretty poorly. And if you remember too, in 2023, it was a dire performance as well for most of them. So really the last 2 years have been pretty dreadful for investors in these various stocks. Yes, the larger ones haven't done too badly, but some of the smaller ones have really experienced problems. And we actually have lost at least 2 of the companies in the sector compared with last year. What we've done as Hardman in recent years is to publish a report on the previous calendar year's operations for these various companies. And hopefully, as far as they're concerned, 2025 will be a rather better performance than we've seen for the last 2 years.
Okay, that's a positive. Were high interest rates the key negative for the sector?
Yes, that's very right. Interest rates are absolutely crucial to valuations. And certainly in recent months, there was a widespread expectation that interest rates would continue falling, but they got rather stuck for the moment with all the various other problems. It's quite likely that they may well be going up rather than down. In terms of valuation, we've seen many of the IICs and RIFs suffer really badly in terms of very large discounts to net asset value, driven very much by interest rates. After all, if you can earn totally risk-free between 4.5% and 5% per year buying 10-year government gilts, you need a fair old premium over that sort of figure to justify the additional risk of investing in these particular stocks.
Yeah. And did we see a significant difference between the IICs and reefs in terms of share price performance?
Yes, there was a significant difference. That's probably fair to say, but the larger stocks did considerably less worse than many of the smaller ones. For example, 3i Infrastructure, which has always been a bit of an outlier, takes a rather higher risk approach and has done extremely well in recent years. Big dividend increase projected for this year, over 6%. Compare that with most of the others, and 3i Infrastructure is perhaps living in a different universe as far as investors are concerned. HICL, BBGI, and others, whilst their share price went down, have still got reasonable dividends, even though in HICL's case, it hasn't been increased for many a year. Of the smaller renewable investment companies, there are real problems, and we've seen some exits like Asian Energy Impact that has now left the sector, and several others are subjects of management wind downs, which essentially is investors saying, look, it's not making money, it's not working, sell off the assets as soon as you possibly can and return the proceeds to shareholders.
So we had continuation votes and managed wind downs become a feature of the sector in 2024. Why is that?
Mainly because the returns of some of these particularly smaller companies has been so disappointing. And that's part because of interest rates, part of other factors within the energy sector. Some of the expansion plans haven't really worked. Put that all together, and some shareholders, particularly the smaller, more recent flotations, have said, look, it's not really working. Let's have our money back. We'll be not supporting a continuation vote. We will want the company to close down and sell off the assets, which may sound a very negative move, and it is. But we've seen recently with triple energy transition that you can actually sell off the assets, which they've done within 13 months, and generate a pretty reasonable return in terms of the portfolio value. I think in that company's situation, they've managed to realize something like 89% of the portfolio value.
Okay, yeah, makes sense. And if we look at the dividends, how did the sector perform on that front?
The answer to that is adequately. Many of them avoided dividend cuts, but dividend growth has been pretty elusive. In the case of HICL, we haven't actually seen dividend growth for over 5 years now. Some of the others, 3i Infrastructure being an obvious example, has done very well on dividends. And on the energy sector, there's no doubt that Greencoat UK Wind has got a far better dividend profile than most. Well, they did warn very recently about the concern on relatively low wind speeds that has substantially reduced their generation output. So the smaller ones are struggling. Dividend cover, in many cases, is quite low. And if you actually look at the dividends, any increases, in many cases, are barely above a nominal figure, with 2 or 3 exceptions.
Mm. So I guess, for the leading sector players, they've managed to maintain it, but how secure are those dividends exactly going forward?
That actually is one area analysts are looking at very carefully in terms of dividend cover. If you've got dividend cover of 2 times, you could argue it should be pretty secure. And certainly on some of the IICs, there are decent dividend covers. But where dividend cover is, in some cases, 1.1, 1.2, you don't need very much to blow that number down a bit and end up with uncovered dividends, and then companies really have to decide what to do next. In the case, for example, of the US RIFE, Ecofin, we saw a very big cut in their dividend a couple of years or so ago, and that is continuing. So there are some companies really struggling, others on the dividend front are reasonably solid.
So I guess it's been quite a tough backdrop. There's been a couple of challenges in the sector, but what exactly is needed for the sector to recover its previous ratings?
Interesting question. I think if interest rates were to come down significantly and to be seen by the market as coming down for some considerable time, that would certainly be beneficial. But you have to remember, with all the backdrop of the UK government's debt, the 100% figure of GDP, etc., put that lot together and real difficulties in controlling public spending. And there are some who say, look, a scenario where you've got low inflation and low interest rates for the next few years is probably somewhat illusory. And to that extent, that is one of the reasons I think why share prices in the sector, with a few exceptions, have remained pretty weak.
All right, Nigel, thank you so much. That's really appreciated. To our viewers, if you'd like to read Nigel's full notes, head over to our website. We've got the link in the description below. Otherwise, please do like and comment on the video wherever you're watching. Every piece of engagement really does help. And please don't forget to subscribe if you haven't already. Thanks for watching, and we'll see you back next time.